Sarah Foster, an analyst at Bankrate.com. There's no shortage of headlines, of course, Sarah. So much already to digest to kick off 2024 trading. Today, more reminiscent of last week, but what do you make of today's CPI, which, of course, a little bit hotter than expected?
We've always been in the camp that, of course, this disinflation we've been seeing is a good sign, but we've always kind of regarded the fact that the next mile of getting inflation down to 2% or at least near 2% is going to be the hardest. I think something that remains to really be felt among consumers and even investors is that sticky inflation is causing fatigue, it's impacting essentials. Consumers are paying more for rent. They're still spending more than they were before the pandemic on food
Mhm.
costs. And even I think something that really stood out to me in this report is used car prices. We expected kind of a tick down there, but actually they edged up a little bit higher. So, according to our latest survey of economists, most of them are in the camp that inflation won't hit 2% until 2025. So, a little bit longer here of the mile.
Yeah, it seems that used car prices were the X factor in this one, kind of swinging those who maybe saw it in line to lower, of course, to the slightly hotter than expected print that we saw. I saw several kind of call outs to that, so appreciate that one. But we also heard from the Fed's John Williams, as well as many other Fed officials, really since we heard from Jerome Powell at the FOMC meeting in December. That we're kind of pivoting back to this higher for longer, or at least they're trying to get that message out there. That was sort of the most recent commentary. But it does really seem that the next question is more of when do the rate cuts start, not if. Where do you see that timetable kicking off, Sarah?
Well, we know that 2024 is likely the year, but we're kind of split on whether it will happen in the beginning or the end. So, the
Mhm.
first half or the second half. I think, especially with this latest inflation report, I mean, we did see some good news on that core print, but with overall prices edging up a little bit more than expected, we're kind of in the camp here that maybe March could be taken off the table. But of course, we have lots of data between now and then. So I think that the big takeaway is really that higher for longer is part of the next kind of question that the Fed will have to answer. And of course, the longer that this goes on, the longer interest rates are in this higher level, the question really then becomes the dual mandate. I mean,
Mhm.
not so much necessarily are we focusing on inflation, but also what do these higher interest rates mean for the labor market? And of course, right now we're seeing some moderation, some slowdown. I wouldn't necessarily say it's a weakening, but we do know that this is the ultimate wild card. And kind of going back to our latest economist survey, we do still see that a hiring slowdown is on the horizon.
And we've sort of seen that in the data. It doesn't seem that hiring is off the charts, but the layoffs really haven't picked up either. It's almost like the labor market's like somewhat frozen compared to history, but we'll see if that trend continues. But Jerome Powell said it himself. I mean, he talks about not making the mistake of prior Feds, of waiting too long. They want to get out ahead of this. They really want to secure that soft landing. But one of the things you said, Sarah, off the top was talking about how you guys anticipate this last mile being more and more difficult. Given the CPI still being a little bit more sticky, a little bit hotter than expected, giving kind of credence to what you're talking about, how focused are you on tomorrow's PPI announcement? As sometimes it's sort of seen as that pipeline for potential future inflation.
Yeah, I think, the totality of the data is really what matters here, and not necessarily one individual report as influencing Fed policy, but what the broader trends are showing. Inflation expectations are also something to really keep in mind here too. We did see some good news there from before, and I think that generally speaking, the edge has been taken off from the Fed to raise interest rates more than they are here. And we even saw in the latest projections that no official is at least expecting right now that they'll have to raise interest rates. But it's this totality of the data that really matters moving forward as far as bringing that timeline into view of when rate cuts could begin. PPI is, another kind of data point that could influence inflation. But even more broadly speaking, I think what we see in the next few months moving forward as we get closer to that March meeting, that's what's really going to matter most.
Odds of the rate cut not changing day over day. We'll see if that changes a little bit as the day rolls on, but pretty firm at that 70% mark. So we'll see what happens. I'm looking forward to the next few months. Appreciate the insights. As always, Sarah Foster, analyst at Bankrate.com. Appreciate it, and thanks for being here.